Hello and welcome to this edition of Closing Trades. Right here on ET Now with me, Aisha Faridi, and what a respite coming in for the markets finally. It's been quite the, bad week that we've had, starting off from Monday, Tuesday being a trading off, and then picking up on the weakness on Wednesday and getting only excruciating yesterday. So finally seeing a bit of a respite, much needed one at that, but one has to add that we're not alone in this respite. The rebound is pretty much across the globe. Strong print coming in from the US GDP, strong handover from the US equity markets, Asia picking up that same momentum and pretty much being followed by the rest of the European markets as well this afternoon. So we're rebounding with the rest of the globe and we managed to eke out decent sort of gains. So we're back around that 19,150 odd print on the Nifty future, start of a new series, and it's not looking all that bad so far. But of course, the bigger question is whether we're out of the woods or not. While yes, you've got support coming in from a Coal India, from an HCL Technologies, broader markets as well are seeing quite a bit of respite. All sectors are trading in the green. And then, of course, you've got due support coming in from some of the earnings specific news as well. Remember, a large weightage of the index reports its numbers today. The big one, of course, is going to be Reliance Industries, only post-market hours. And that's something that the market is only going to be reacting to come Monday. But for now, you're seeing quite a bit of respite. Maruti just came out with its numbers. The numbers are on a beat on all fronts. And you are seeing the stock hit a fresh record high right now. Good earnings delivery from a PNB as well. That stock is holding up 4.5%. Of course, these are numbers which came by yesterday. Canara Bank, which is now sitting at a gain of about almost 7%. And then Shriram Finance as well, which posted a blowout set of numbers. Almost an 8% gain is what you're seeing on this particular stock. So not bad at all, but the question is whether it all sustains or not. In fact, on that note, let me bring on board our experts and question them about exactly that. We've got Kush Bora on the show right now. We also have Shibani Sarkar-Kurian as well as Sudeep Shah joining in on the charts. Gentlemen, Shibani, hi, good afternoon. Good to have you on the show. Kush, if I could just get in a word from you, from those extremely oversold levels where we closed in yesterday, even sub that 18,900 print, what does today's rebound mean on the charts? Are we out of the woods?
Hi, Aisha. First, thank you for having me on the show. To answer your question in a very simple way, not at all, not even close. I'll give you a very simple reason. The Bank Nifty has seen a lot of pressure, trading below its 200-day moving average until it takes out that 43,200 kind of level. I don't think, we'd be safely, out of the woods. Also, if I look at Nifty, a broad congestion zone for Nifty was 19,200 to 19,600, where it spent a lot of time, back in, July, August, September phase. Even this time around before breaking down, it did spend some time in that zone. So until we take out 19,200, 19,250 on the Nifty, I think we will perhaps remain, a bit cautious. Too early to say that the tide has turned and, we should be buying from here. It's just that, a shorting at these levels wasn't really an option. And hence, this bounce was overdue. We would have perhaps had this bounce probably a day earlier, had it not been the, monthly expiry yesterday, where we saw massive call writing. So I won't call it out of the woods yet. It's just that, it's a very encouraging sign that the bounce has come and quite a sharp one at that. 19,200 on the Nifty and 43,200 on the Bank Nifty are the levels that I'm looking at. Above these is when we can say that, safely that we could perhaps be looking at a turn of, the tide from the indices perspective at least.
Shibani, hi, this is Vinny this side as well. What I also want to understand, Shibani, in the markets, what we saw was a sharp fall that actually came in the broader markets as well, right? And when you look at the recovery today, that is also leading the recovery versus the benchmark indices, the broader markets. So what is the trend that we are seeing coming in for the broader markets? Do you think that fall we saw during the week is something that will continue for the broader markets?
Hi, good afternoon. So when you look at the market move ever since April of this year, the broader markets have clearly led the way and have massively outperformed the large caps or the Nifty. Now, the way we look at the overall market construct between mid cap, small cap, and large cap, if you look at just on terms of valuation, both the mid cap index as well as the small cap index is trading at multiples on a 1 year forward basis, which is significantly higher than its long term average. While the large cap Nifty is trading at pretty much reasonable valuations today, which is close to long-term averages. So on an absolute basis, mid and small cap given the kind of outperformance that they have seen, are trading at multiples which are higher than their own average levels. On a relative basis as well, if you look at mid cap, small cap versus large cap, relative valuations are also fairly stretched and are again at an all-time high level. So our belief is that in the near term, given the kind of valuation disparity that you are seeing between the broader market as well as large caps, it is possible that you do see far more volatility in the mid and small cap segment vis-a-vis large caps, where valuations are far more reasonable. So at this point in time, we would believe that at least in the near term, large caps are better placed than mid and small caps. While on a longer term basis, of course, there are very many industries where being present in mid and small caps is possibly the only way to play the overall India growth story. But near term, it does appear that valuations are stretched on a relative as well as absolute basis.
We'll pick up on that point forward. The good thing so far is that while you've got almost 15.5% of the index weightage reporting its numbers, some of them have actually managed to cheer the street. Case in point, of course, being Maruti. Of course, later in the day today, post-market hours, you'll have Reliance. And that heavyweight with its over 9.5% weightage is definitely going to have a bearing on the market, if at all the numbers are market moving. We'll talk about that also in just a bit. But Maruti just came out with its numbers, as did Cipla. There's BPCL, SBI Life, DRL. They're all slated to come out with their numbers, as is Bajaj Finserv with its 1% weightage on the index. But Shivani, just, your thoughts. I don't know if you managed to, take a look at what Maruti's performance as well has been. It's really a beat on all counts. So good numbers when it comes to Maruti, and they've recorded their highest ever quarterly sales volumes, net sales, net profits in the quarter, highest sales. Of course, it's been owing to the kind of sales volumes which we've in any case seen come by on a monthly basis. They've achieved the market share target of 23.3% in the SUV segment. What does that tell you about what we're likely to hear from the other passenger vehicle makers?
Yeah, Aisha, if you look at the entire auto pack, and of course, we've been tracking the monthly volume data, volumes have been fairly buoyant, especially where the passenger vehicle segment is concerned. And within that, the premium end and the SUV end has been showing fairly strong growth over the last few months. Now, the other factor to note, where again the entire auto pack is concerned, is the margin trajectory. Given the fact that input cost pressures have abated considerably, our expectation is that we should see margins continue to expand, and that should also help in terms of the overall growth. The third factor, of course, has been the demand trajectory going into the festive season, where again you've seen an improvement in terms of demand. And of course, we will have to see how things pan out from a growth number and volume growth on a stock-specific basis. But we believe that if you look at the earnings trajectory for FY24 for the entire auto pack, earnings should remain fairly healthy. And within that, the passenger vehicle segment should perform fairly well. And therefore, if you look at the way we are placed in the auto segment, we have been considerably overweight for a while, and that overweight stance and positive stance continues.
Shivani, stay with us. In fact, since we're on the subject of Maruti, by the way, the stock has managed to hit a record high post its numbers, which are a beat on all counts. Let me take it across to Shrishti and get in some more details on how the quarter has been. And Shrishti, what's actually delivered for the numbers to be a beat?
When we talk about the numbers, then the kind of a volume jump that the company has seen was 7% on a YY basis, and sequentially the volumes were up 11%. So the richer product mix, because we were expecting that the SUV sales mix has gone up, so that will really support the margins. But the street was expecting the margin to be around 11 to 11.5%. We at ET now estimated EBITDA margin of 11%. But look at the surprise coming in, almost a 13% margin is what the company has clocked in on that particular front, where the company says that the higher other operating income, the richer product mix, the cool off in the raw material cost prices, all these factors have supported the margin. So that's really a surprising factor. And this time around, the stock is not just the stock is at a record high level. If we look at the other quarterly earnings from the likes of revenue, profit, margins, they all are seen to be hitting a record high level for themselves. Highest ever quarterly sales volume, net sales and net profit for the quarter registered the highest sales owing to the higher sales volume and product mix and achieved the market share of 23.3% in the SUV segment. The revenue has seen a jump of 15% on a sequential basis, EBITDA jump of 60%, margins like I told you close to 13%, and the profit figure has seen a jump of 50% on a sequential basis. So on all the parameters, there is a beat by Maruti Suzuki. The material cost has also cooled off to 73.5% this time around, and that's a cool off of almost 30 basis points on a YOY basis. So all these factors have really supported the Maruti Suzuki earnings, and definitely autos are on the roll today.
We're keeping an eye out on the auto sector. But, when we're talking about Maruti, Sudeep, I'll come to you, We've spoken about the fundamentals, we've spoken about how the numbers have been as well. Today, as of now, Maruti is trading near the record high levels. It hit a record high intraday. On the charts, do you still expect to see an upside coming in for Maruti?
Well, good afternoon, everyone. See, Maruti posted numbers. It has seen a spike in the last 1.5 to 2 hours. But overall, if we see the structure since last couple of months, the stock has been outperforming, while the Nifty as well as the broader markets have been under selling pressure. Maruti is just trading between this 10,300, 10,600 mark and near its all-time high. So I feel that from the current level also, even if we see a slight recovery in Nifty, Maruti would do wonders from here, and this outperformance could take it past around 11,000, 11,200 on the upside. Because if we see the short-term moving averages, the 20-day exponential moving average is placed around 10,500, with the stock has recaptured today. And we feel that with the good results that have come in today, that would be supportive, and the stock on the upside could retest 10,900, 11,000 on the upside, and one could keep a stop loss of 10,550 for the same.
As well on your screens right now, 166 on the consolidated PAT versus a comparable of 121. Let's just bring up what the other numbers as well are showcasing. The revenues as well have come in higher, 1433 crore rupees. I don't know if they're going to, get in more details in terms of what the ARRs have been and what the average bookings have been. Vinny, do you have more details? So
we, as of now, just have details coming in terms of the EBITDA performance of the company. Given the trends that we've seen in the hotel business as well, that, we are seeing an increase in terms of overall the occupancies. And that is what we're expecting to see as of now for Indian hotels as well. That increase in occupancy, that will be something that will be supporting the company's growth. Plus, going forward, also, we are seeing that festive season is now coming, holiday season is coming, that will further be supporting them. Margins also have seen an expansion this time as well. And, that is why we saw that jump up coming in the stock price at the beginning, but now seems like a slight bit of a cool off once the results have come out. We'll keep an eye out on more details as of now, Aisha. The press release is not yet out. We're only seeing that the statement numbers is out as of now. So keeping an eye out on that press release that will be coming out soon as well.
Shivani, that's the other thing, because much of the rally and the positive is already played out when it comes to the entire hotel sector, right? In the massive recovery that they've seen from the COVID lows. Do you think there's merit in A, staying invested, and B, buying afresh into any of these names?
So yeah, you're right that a lot of the rally has happened because of the improvement that you have seen overall in terms of numbers. But couple of things that I think structurally should play out for the sector going forward as well. One is that while leisure travel has picked up considerably, leading to occupancy rates improving, the supply overall remains fairly constrained. And therefore, occupancy levels, given that we are going into the festive season and then the holiday season, should remain fairly elevated, which should support numbers. The second fact is that now you're starting to see business travel also come back in a big way, which should again support occupancy as well as room rent. So overall, we believe that while yes, in pocket valuations have become expensive and therefore one should be mindful of valuation, but structurally, if you look at the sector as a whole, the trajectory of growth as well as better profitability should continue for the time being.
Right. Okay. Kush, what is your reading on the charts of IHCL? While, of course, that's the most preferred one in the entire, hotels pack. But even some of the smaller ones like a Chalet, etc. Where do you see, merit in going long at these levels?
First up, I agree with the view that a lot of the rally has sort of played out, and if you see, some of these are actually trading either very close to their support zones or maybe a little lower. So Indian Hotels, 380 was a very strong support zone, and it's hovering around that. And right now, currently as we speak, it's a little lower than that. So my sense is that this is one space that is perhaps best avoided if someone has it. My suggestion would be hold it with a trading stop loss. Don't look for new positions in this. See, as far as Chalet goes, fairly similar view. The stock has a support at 550 560 odd levels, and it's trading very close to that. However, it's slightly better placed than Indian Hotels, but then again, Indian Hotels had a much sharper rally as well. So if someone wants to play, maybe some of these smaller names are a better bet. But just for now, and given the kind of tricky situation that the markets are in, I wouldn't want to venture into a space which is sort of losing momentum. I would rather pick something that has momentum. So Chalet, Indian Hotels, most of these stocks would be on my wait and watch list. I wouldn't really look at a trade from here on in these.
Okay, so that is in the wait and watch list is the hotel space coming for Kush. But look at SRF numbers also. They also have come out as well as of now. When you're looking at in terms of the numbers for SRF, yes, revenue seeing a decline of almost 15%, profits down by almost 38% as well, and margin seeing a contraction of around 100 basis points. We saw that the stock slipped in trade, but yes, waiting out for more details in terms of any commentary that has come in. But SRF as of now, subdued, recovered again after the numbers. Keeping an eye out on that. On that note, we'll slip into a very short break, viewers. Don't go anywhere. We'll be back with more updates after the break.
Back with closing trades right here on ET. Now you've got SBI Life's numbers currently on your screens. We were expecting the APE to come in higher by about 29%. You've got the persistency ratio, which has seen an uptick. The net premium income has seen a jump up, so has the PAT to about 380 odd crore rupees. The stock though is languishing a little bit. I don't know if we couldn't bring up the intraday graph very quickly to show you how it's reacted to post its numbers, because it's seen a bit of a dip down. I don't quite think those numbers are matching as to what the street was anticipating.
Because I think, Aisha, the street actually was expecting a revenue of around profits of around 443 crores. So that is coming in a miss, at least on that front when I'm checking the estimates as well. So let's keep an eye out on that number, because operating profit also 532. I think it believed that it's come slightly below that expectation. So that is why that fall is coming in terms of the numbers. We are still waiting out for the press release in terms of the APE growth, Aisha. That's when we'll come to know the VNB as well as the APE, how have they performed. But as of now, seems like a bit of a miss, at least coming in on the profitability front, Aisha.
Yeah, absolutely. The margins as well don't look like they've matched up to what the street was anticipating. So you are seeing quite a bit of gash down now. In fact, the stock has slipped a good 0.5% as we speak right now. But what's looking good? Let's focus on that, considering it's a day of a rebound and a much needed respite at that. And, Shibani, we were discussing earlier today as to how some of these private banking names, both the performers as well as the non-performers, are all trading at significantly cheaper valuations to their 5-year averages. Just wanted to understand whether after the recent corrections, you think private banks are a good buy.
So you're absolutely right. If you look at the entire private banking pack, especially the larger private banks, in terms of valuations are significantly lower than their own historic average multiples. Now, this comes at a time when the entire pack has actually seen significant improvement where the return ratio profiles are considered, and therefore over the last few years, you've actually seen expansion where return on equity for most of these banks go. Now, the other factor to note is that the private banking pack continues to gain market share. So if you look at even the latest quarter numbers that have come out for some of the banks, loan growth continues to be in excess of the industry average growth, and deposit growth also continues to be fairly healthy. So business numbers continue to be fairly healthy, and these banks are gaining market share. The asset quality profile for the banks remain healthy, and more importantly, most of these banks are running provisioning coverage ratios which are in excess of say 75-80%. So credit costs should remain fairly under control. And the third most important aspect is that capital adequacy ratios for these banks are also in excess as compared to the regulatory requirements, and therefore the runway for growth remains fairly healthy. Now, while in the near term, there will be some pressure on margins because all of last year, as the interest rate cycle was moving up, margins also
With Shibani, just going to get back to her and get in her take again. But, well, the big boy, Reliance as well, slated to come out with its numbers only post-market hours, late evening today. Hopefully, it shouldn't be that late as it has been in the many quarters in the past. But let me take it across to Samit. First, find out what to expect from Reliance, and then he can also highlight what the anticipation from Jio in particular is.
Well, Reliance Industries on a consolidated basis is expected to report a good set of numbers. If you see the company's revenue, they're expected to be higher around 10% on a sequential basis. The EBITDA is expected to increase by around 6% while net profit is expected to be higher by around 11%. Now, if you see segmental wise, it is the gas exploration segment that will lead the growth with around 23% sequential growth when it comes to the gas exploration segment EBITDA number. When it comes to the retail segment, the revenues and EBITDA are expected to be higher by around 5 to 6%, while the O2C segment EBITDA is expected to increase by around 5% on a sequential basis. Now, the growth in the O2C segment would be purely coming in from the refining segment because it was the GRM strength that would lead to a higher growth. However, on the negative side, if you see petrochemical margins were on the weaker side, while there was also maintenance shutdown because of which there would be some negative impact on the O2C business. When it comes to the gas exploration business, that would see a 23% growth purely on the back of higher gas production and higher gas prices on a sequential basis, while the retail segment growth would be purely on the back of higher footfalls and store expansion that the company had done in the second quarter of FY24. Well, Reliance Jio, that is the telecom arm of Reliance Industries, that would see a muted set of numbers. Revenues are expected to be higher by only 3%. EBITDA is expected to be higher by 3.5%, while net profit would also report similar kind of growth on a sequential basis in the second quarter. ARPU number is expected to grow by around 1%, while subscriber base, now here we are seeing a growth for the 6th consecutive quarter, and the subscriber number in the second quarter is expected to come in at around 45.7 crore subscribers. Now, whatever growth that we are seeing on revenue and EBITDA front would be purely on the back of higher subscribers and sequentially higher ARPU. Now, sequentially higher ARPUs are expected to increase on improving subscriber mix and rising broadband subscribers on its total network. Apart from that, the key things to watch out for from Reliance Jio and Reliance Industries earning would be their margin outlook when it comes to refinery and the petrochemical business, the capital expenditure that they are planning towards the new energy business, what is the roadmap of the new energy business, and when it comes to the telecom business, it is the ARPU trajectory, what is the commentary, when are they planning to take a tariff hike, how has been the response when it comes to the Jio Bharat going forward, and what are the capital expenditure and 5G monetization plans going forward. These are the key things that one needs to keep an eye out for from Reliance Industries and Reliance Jio earnings.
Yeah, absolutely, we do. Shibani, just wanted to understand from you anything that you're anticipating in the earnings commentary that could finally lift the stock up. I mean, it's been an underperformer for what, almost 34 odd months now?
Aisha, unfortunately, will not be able to comment specifically on a stock. So, yeah.
Okay. Just wanted to get, Kush, your take as well on what you see on the charts and whether we can see any meaningful pickup coming in, because it's been struggling for quite some time.
It's actually a little close to its support zones, and this is the first day of any kind of rebound that the stock is actually seeing. So a little too early, and I would attribute this rebound also to an oversold nature that the stock had gone into for the last couple of days. So a little too early to say whether this is the near-term bottom for the stock or it's expected to rise sharply. What I can, however, suggest is 2300, 2320 are the levels that I'm looking for, where also the 20-day moving average for the stock is placed. If it crosses that, is perhaps when we can say with some comfort that yes, indeed the near-term average isn't, or rather the near-term bottom is in place, and from here perhaps the stock could at least go sideways, if not up. So I would be a little cautious. The first day of the rebound, I wouldn't be buying. And as I said, a 2320 is the level that I'm looking at on the upside. Once the stock moves above that, is perhaps we could consider a fresh entry.
Right, and Sudeep, let's get in your view also for Reliance. No one should miss out on Reliance. What are you picking up in terms of technical levels?
See, I concur partly with Kush because it's the first day of rebound, and from lower, the stock in the last 5-6 sessions has formed a lower top, lower bottom formation, and it had also breached its 200 DMA, which was around 2285, 2290. So the first level I would be closely watching out for Reliance would be 2285, 2290. That this zone has to cross, and the stock has to sustain about this level. And on the upside, if we see 2300, that is the zone where maximum call writers are placed if we see the derivative data. So if you add the premium and adjust the premium accordingly, then 2320 would be the first resistance. So this zone of 2285 to 2320 will act as a cluster of resistance, and only above 2320, if Reliance sustains, then I feel a bigger move up to 2390, 2420 could be on the cards. So 2285 to 2320 zone would be the main level that one should be watching out for. And only if the stock sustains above this zone, one can go ahead and buy this.
Okay, just want to bring up SRF as well for you on your screens, because the numbers just came out, and more than that, it's actually the commentary, which is something that the street should be taking heart from, because, you know, while there is been all gloom and doom across the, you know, chemical sector, what the CMD has actually said in their commentary is that they're now beginning to see some positive traction that should bode well for a better second half of FY24. And you can see that big spike up coming in on SRF, reacting to that commentary coming in from the management. Shivani, just wanted to get your sense on SRF. You know, good guidance clearly coming in from the management at a time when some of the global players have cut their guidance. You know, we've seen the correction play out in chemicals. Do you think this could be a good contra bet?
So, Aisha, to answer your question specifically for the specialty chemicals space, now, of course, we have seen that, we have seen significant impact over the last few quarters, primarily because channel inventory was extremely elevated. Apart from that, pricing pressure was seen, and globally demand has also been soft. So, therefore, multiple factors which have driven down stock prices. However, when you look at from a slightly medium to long-term perspective in terms of the growth prospects that are there in the specialty chemicals sector, we remain fairly positive. The sector also remains a beneficiary from a China plus one strategy. India's market share in the entire global chemicals basket is very, very low as compared to China, which is mammoth. And therefore, even a small shift in market share away from China to India remains a structural theme for the sector. So yes, while in the near term demand trends have been weak, we do expect that over the next 6 to 8 month period, some of that should start to come back as well. We are also seeing initial signs of price stability come through, which also bodes well from a sector perspective.
Okay, Shivani, thank you so much for joining in with us this afternoon on Closing Trades and giving us your views on the markets as well as specific stocks. But let's keep it going, and Sudeep, going to come to you. What are your closing trade picks?
My first pick would be Trent. See, if we see this stock, the rollovers have been very good. The stock is in an overall uptrend, and it was consolidating in the last 15-20 sessions. And once again, now the stock has managed to climb above its 20-day exponential moving average, which is placed around 2060 odd levels. So with the kind of pattern that the stock is forming today and the volume based action that we are witnessing in this, I feel the stock is good to go up to 2200, 2230 on the upside, and one can buy this with a stop loss of 2080. And my second pick would be L&T Finance. Now the rollovers have been very good in this stock. And also the stock in the last 15 days has just consolidated between 130 and 135, 136 on the upside. While Nifty corrected by over 1,000 points, the stock did not even fall by more than 4-5%. And once again, at the first possible opportunity of a rebound, the stock has come back to its highest trajectory. So with the kind of open interest built up that the stock is showing, daily, weekly, monthly charts are showing bullishness. I feel that this stock can be bought at current levels with 132 as a stop loss and 145 as a target on the upside. And this target could be achieved within the next 3 to 5 sessions.
Right. Kush, what about your closing ideas?
So a couple of stocks on my radar from the cash side are Newgen Software. If you look at the price movement of this chart, I mean, it doesn't even show any kind of a correlation with the market fall. Of course, there was a day or two of blip, but you could actually very well attribute that to profit booking because of the sharp run up that you had seen. So all in all, the stock looks good from here as well. I would look to targets of 1250 and 1275 on the upside. 1170 is where I would place my stop loss. The second stock on my radar is GMDC. Again, the stock had seen a very sharp run up. Came down with the market fall, but if you see, it's respected its 20-day moving average for the last 3 to 4 sessions, and moving higher along with the 20-day moving average. So from here on, 385, 400 is the near-term target that I have on GMDC. 350 is where I would place my stop loss.
Okay, stay with us, both of you. Lots more to talk about. We'll take a very quick break on that note. Track the last lap, half an hour of trade for this week on the other side. Closing trades right here on ET now. Quite a bit of respite coming in, not just for our markets, but for the global screen as well. We're back at that 19,048 mark. So roughly skirting around that 19,050 print. But take a look at the rest of the globe, because like I said, the strong handover from US equity markets as well has been strong. Asia picked up the same momentum, and even the European markets are holding out in the green as we speak. In fact, not just that, the US futures are also indicating to a very positive start after the US GDP print came by and the recovery that you had in the equity markets. Even right now, you're scaling almost 85 points higher on the Dow futures. S&P futures as well, 0.5% uptick coming in there, and a solid move for Nasdaq futures, which is trailing higher by about almost 1% as we speak right now. Kunj Bansal too joins in on the show. Kunj, hi, afternoon. Good to have you on the show. Kunj, should we be reading at all into today's recovery, because it's coming in from a very extremely oversold zone as well? Are we out of the woods or not?
Yeah, so as we all know, these are always difficult calls to take. Having said that, if we analyze the overall scenario, you are right that for last 6 days, except today, we were continuously falling. And after that, at some point of time, partly a sentimental correction, partly a technical correction, partly a breather was to come, which has come today, which could be due to multiple reasons. One, of course, was yesterday's was futures expiry monthly, which is over now. Two, of course, at the end of the today, we will know that have FIIs change their stance in terms of liquidity inflow, which was continuously negative for last few days. So the good thing that has happened, as we all know, is that while domestics are always net buyers and continue to support market. Now, earlier, till about 2 years ago or so, it used to happen that when global funds would sell, our markets would short-term turn negative. Now, they don't turn negative, but the going up stops. So what I mean to say is that when domestics and FIIs, both of them buy, the market keeps going up. When domestics, which continue to remain buyers, they remain buyer, and a global turn seller, the domestics absorb them and the market becomes flat. And when the net selling becomes, obviously the market falls, and which is what was happening for last few days. So let's see, but still, if we take a view, I think now we should gradually get into a range-bound movement of the market for multiple reasons. Result season almost half has been through, which has been on the expected lines, mixed in some sectors, not as good, some sectors better than expectations. We have next week the US Fed number coming in again, and with yesterday's GDP growth rate of the US market coming in, I don't know which way to read it. A good GDP of 4% plus shows economy doing very well, but at the same time, it brings in concern that will make the Fed hike the interest rates again. So if any such fears come into the US market today overnight, then we might have a different scenario on Monday, and in any case, next week we have US Fed decision. So all these factors will be there. Taking a net of these, having seen the sharp upward movement that we saw in September, followed by correction last few days, I think we will get into a range-bound movement of market instead of trying to take a one-way direction.
Those fears is something we'll have to watch out for, surely, Kunj, that will come out overnight from the US markets as well, and maybe a range-bound move is what we're expecting. But, Sudeep, I'm going to come to you. I want to actually talk about some of these smaller NBFCs, whether you look at a Shriram Finance or whether you look at something like a Ugrow and the MSME side of these NBFCs. That was something that was doing well, right? Now, in terms of anything that you are finding exciting in the space or something that you would look at on the NBFC side?
See, within the NBFCs, if you see the large cap names, bigger names, now if you see Shriram Finance, now Shriram in the last at least 6 to 7 months, it has been trading in a tight range between 1800 and 1900, 1920. but today we have seen a bigger breakout in this stock. So the short to medium term charts were as it is bullish, and today we have seen a follow-up action on the upside, continuation on the upside. So I feel this stock could do well in the next few weeks also, and positionally it is showing a good momentum on the upside. So I feel from the current levels, Shriram Finance could be bought around with 1900 stop loss and 2000 target on the upside. The second stock within the NBFC space, which I am liking, is Muthoot Finance. Now, in the last 15 days, while the markets were falling and we were seeing a lot of mid caps getting battered, this stock was quietly trading around 1250, 1270, and there were deeper cuts were not being visible there. So also, if we see the rollover data, the above average rolls have happened here compared to the 3 months average. And today also the stock is showing a good bullish momentum on the upside. So while the daily and weekly charts are exhibiting bullishness, the stock is sustaining above its short-term moving average of 20-day exponential 20-day EMA, which is around 1250, 1255. So I feel till the time this zone is guarded, we can expect Muthoot Finance to move up to 1330, 1350 on the upside, where the previous swing highs are placed, which were recorded in the month of August. So apart from Shriram Finance, I feel Muthoot Finance also is slated to do well, and L&T Finance I've already shared as a pick. So I feel that this entire space could do well in the next few weeks.
Right. Kush, I'm going to come to you. What is your view actually coming in on some of these, you could call them new age tech names, right, on the charts now? Zomato obviously had seen such a run up coming in as well. Paytm, after that sharp fall, last year, we're seeing that recovery has started coming in Paytm, holding on to gains also in the last couple of months. So anything that you would find attractive in these new age tech names, it's so-called?
The two that you mentioned, Paytm and Zomato. And what the good thing is that, after the rally that we saw in the last, 6 to 8 months in these stocks, what's happened is that, the investor confidence has sort of come back. After the, sharp slide we saw in both the stocks after the IPO, the confidence was missing, and, there was selling pressure at every rise. Now, at least these stocks are in a place where you could consider them as a trading bet as well, because, support does emerge at lower levels, and a lot of them have been in an uptrend. So both these stocks, that you mentioned have been on my radar. I was checking Nykaa as well, while you were speaking, but it doesn't just have the same kind of, rigor or momentum to it. So Zomato and Paytm are the ones that you should have on your radar. Although a lot of move has already been done, and they might go into a consolidation phase, but that's again a good thing. You don't want them to move up, in a vertical run. So Zomato I have on my radar. After a correction from about 115 odd levels to 105, this is a good time to accumulate. I would have my stop loss close to 99, and the 115 high that it recently touched would be the first level that I would look for. 130 is the next level that I would look for in Zomato. As far as Paytm goes, again, the stock is in a bit of a consolidation phase, missing momentum right now, but that again might turn out to be a good thing. Here, 855 is where I would place my stop loss, and on the upside, we're looking at targets of 965 and then again about 1000 odd levels. So both of these have gone into a bit of a sideways move, but that's not such a bad thing.
Okay, well, with the correction playing out in the broader markets all through this week, the big question is, of course, what should investors be doing? Is there a case to now look at this space, or should investors stay away, tilt their portfolio towards large caps, or just do nothing? Here are what market veterans like Devina Mehra, Pankaj Murarka and Pankaj Tibrewal had to tell us.
The small cap index itself churns so much that the stocks that finally make that cross that high again are a completely different set from the stocks that fell. The stocks that fell, a lot of them just go out and go to zero essentially, stop trading, etc. So that part of the market I've been saying for the last month and a half, that's where you have the real risk part. The large caps, of course, you have to choose the sectors carefully, you have to choose the companies carefully. I and my systems also don't still like private sector banks. In fact, the last rebalance we did, we cut back banking in general, and within banking, again, skewed little more towards PSU banks.
We like pharma as a sector because we think there's earning resilience in the sector. And more importantly, the sector is coming out of 2 years or 3 years of underperformance and business challenges. And now a lot of those headwinds which the sector faced has turned into tailwinds. So we see good opportunities in pharma across both large caps as well as mid caps, and valuations there are far more reasonable. And apart from that, we like some of the mid-cap banks as well, financials as well, because we think asset quality in the sector as a whole is extremely strong or resilient.
We have been a little cautious on the broader market space for some time now. And our broader concerns were that the valuations had become too rich and greed was clearly visible on the street and money making had become too easy. Over the last decade, mid and small caps have been the best equity class, and we believe that some exercise and some caution needs to be warranted in the near and short and near term. Even if you look at large cap market cap ratio versus GDP, it has come down to very reasonable levels, and we believe that some rotation may happen from mid and small cap in the near term towards large cap, which are in a much better valuation zone.
Okay, that's about the broader markets. But Kunj, I want to understand in some of these QSR names, right? Whether you look at a Westlife or a Jubilant, in terms of numbers, yes, not that exciting. The discretionary side is not doing quite well. Any view that you have coming in on Westlife or a Jubilant Foodwork, or what are you seeing fundamentally for the stocks now?
So obviously, if we look at the numbers of the consumption companies, in fact, let me extend this discussion of QSR to the broader consumption, including FMCG companies for the moment, then we have clearly seen the expected slowdown that we all knew, that we all have been analyzing, reading, and observing in various macro data that have been coming in. It is clearly visible in the subdued growth, top line growth numbers of the companies. In some cases, in fact, in most of the cases, the good thing has been there has been a margin improvement, largely led by the commodity price correction on a year-on-year basis, which at least one good thing is there. Now coming back, yes, that is an issue. The whole consumption demand continues to remain an issue. All of us in India in market are generally optimistic and should be also. So for every few next days, we adopt a new milestone. So earlier we adopted a milestone that, okay, if monsoon is good, we will see the consumption demand coming up. Now monsoon, okay, you have mixed opinion on a spatial basis, geographical distribution basis. It hasn't been perfectly normal. So that has gone. Now we are into festival season. So probably we are lending our hopes into the festival season recovery that it should happen. Alongside what has happened is the government has increased the MSP, minimum support price of a lot of agricultural products. So that should hopefully see a lot more money going into the farmer's pocket, which means in the rural India. Now, if that leads to the rural consumption coming up, we have of course seen the inflation numbers coming down. Although given the way the oil prices continued to remain high, one doesn't know if we have seen onion prices again coming up. So it's difficult to say on a sustainable basis will inflation continue to remain down. So these are the reasons I think that makes it the overall view on the consumption space. And again, within consumption space, please allow me to distribute into two parts: high-end consumption and low-end consumption. Now, clearly, low-end consumption is something that has been seeing pressure. By high-end consumption, what I mean is we don't see that kind of pressure in the four-wheelers, passenger vehicles. We don't see that kind of pressure in the higher end, let's say footwear sales of a higher priced. We don't see that kind of pressure in the higher priced, higher value, higher average ticket size of the clothing ready-made garment sales. So a high-end consumption is something that probably will continue to do well. The lower-end consumption is something that we have to watch out if festival season lends some kind of help. Till then, it will have to be remaining in wait and watch mode. Of course, the other thing that we keep discussing is the whole valuation challenge of the Indian market. Now, consumer durable is another space which has continued to remain subdued, continued to witness subdued sales growth for at least 3 quarters, maybe more. Now, as a result, valuation there have corrected. Now, it's up to one to take that call that one does one want to take that contra call of buying in lower valuation, seeing some more quarters of uncertainty of sales not picking up, or then not complaining later when the actual sales numbers come in, stocks suddenly move up, that valuation has gone up.
Okay, holding out quite okay so far, at least for the index and even for the broader markets. In fact, we had quite a bit of discussion coming in on the broader markets all through the channel today, views that we just played out as well for you. But the good thing is that some of the earnings as well have delivered. You just saw Maruti. The stock actually reacted, clocked in that record high for itself. SRF, the commentary has been quite nice, though on an average, the earnings season so far is largely in line, barring IT and a few odd other disappointments. But you are seeing some green shoots, within those spaces as well. So, for instance, Canara Bank, PNB, they have come out with extremely great set of numbers. The biggest winner today within the F&O market, Shriram Finance. The stock is holding up 8%. That's been a beat on all counts. In fact, let's hear out what Canara Bank, PNB and Shriram Finance managements, when we chatted with them earlier today morning, what they had to tell us about what the future visibility is looking like.
What we are expecting is it will be around 2.9. That depends on the liquidity availability in the system. The liquidity availability is improved in the coming months. It may not be that immediately. Otherwise, it will be in the next 2 quarters. It will be there.
Guidance which we have given, our NIM should be 2.9 to 3%. But as far as NII is concerned, net interest income is concerned, that will be positive in the absolute number, because there is some transaction which is available in the market where we are not earning 2% or 3% the NIM. So NIM in terms of the percentage may be little lower, but we will try to maintain even the growth in the net interest income in the absolute number.
Our board has approved, our shareholders has approved to raise a capital up to 4,000 crore in the current financial year, and therefore we can approach the market at any time for the current financial year at appropriate time.
And as far as sustaining it is concerned, see, third quarter, fourth quarter, because the demand and since we offer schemes to customers, particularly in the two-wheeler segment, and of course.
Okay, Dr. Reddy's performance in front of you, 1,480 crore rupees in the PAT versus the ET Now estimates of 1,246. So that definitely looks like a beat optically. So I don't want to call it too soon, but let's just wait by for the other numbers as well, because the revenues are largely in line at 6880, what the revenue has, delivered versus our expectation of roughly around 6,700 thereabouts. That's largely in line, but the bigger beat has come in terms of the PAT. For the margins, though, we were expecting a bit of a downtick, more on a year-on-year basis, 27.9% versus a comparable of 30% in the same quarter last year, but on, a dip coming in even on a sequential basis for the margins. Of course, the US revenue is expected to be showing a downtick of about 3% on a sequential basis, while an uptick of 15% on a year-on-year basis. So that's definitely something that we're going to be looking out for. Generic Revlimid sales, we're expecting lower on a sequential basis, partly getting offset by main pharma acquisition, steady market share when it comes to, a Suboxone or a Vascepa as well. And we're expecting the India business to actually show an uptick of about almost 5% coming in. And now you can see the stock react to the kind of beat that it's posted in terms of their PAT and even EBITDA. That's quite a bit of jump up, 2180 versus our anticipation of 1900 thereabouts. The margins too are a beat, 31.7%. So that's definitely higher than what the market and what the ET Now poll as well was anticipating, which is why you can see that reaction come by for DRL, the stock price. So, Kunj, if I could just get your word in, really. Okay. Kush, if I could just get a quick stock reaction on DRL, Cipla also, which came out with its numbers a short while back.
Oh, well, Dr. Reddy has been in a downtrend close to support zones. I wouldn't, touch it with a barge pole, just yet. 5,400, very strong support zone. If that breaks, I am afraid, it might actually slip further. And we could be looking at 5250, 5200 kind of levels also, on this one. Cipla, on the other hand, has shown, a bit of a promise even before, the numbers came, or even before the, markets started to slide. So I'll have this one on my radar. However, here too, 1200 seems to be a stiff resistance, both technically as well as from a derivative perspective. So Cipla is something that I will have on my radar, but I wouldn't go too aggressively, on this if I'm buying. Dr. Reddy's, as I said, I would, very clearly avoid at the moment.
let's take a quick look at those numbers that have come in from North America as well. When you look at the revenues on a quarter-on-quarter basis, the decline is 1%. We were expecting the US revenue to see a further decline of 3%, so that's better on that front as well. And year-on-year basis also, we're seeing a growth of around 13% for the North America business. India business too, separately seeing a growth of around 3% on a quarter-on-quarter basis, and similarly on a year-on-year basis also we are seeing a growth coming in. So the breakup is coming in there, and in the press release they are highlighting that the emerging markets, that's seen a slight bit of a decline as well, Aisha. So yes, Dr. Reddy's slight bit, at least looks like on the first cut that we are seeing a better performance coming in on that front. So yes, Dr. Reddy's as of now recovered from the day's lowest point, holding on almost flattish. 0% is what it is holding on to. But let's move on, look at what Cipla is doing at the end of the day as well, because that reported a good set of numbers. 2% holding on to gains over there as well. NTPC, some of the gainers in that front as well. We have Shriram Finance, top FNO gainer, holding on to good gains there. Other than that, Canara Bank, PNB, RBL Bank, all those banks holding on to good gains today of 4 to 5% in trade as of now. What's not doing well is Sterlite Tech, that's down and out. It's down almost 9% as of now. You're looking at Westlife Food World also is down 7% as well. Prestige Estates are seeing a bit of a subdued performance this week and down 5% as of now today in trade as well. So that's what we're seeing as of now in terms of earnings reactions coming in as well, Aisha. But markets, not a bad day that came in, at least on Friday, holding on to good gains. With that, we are absolutely out of time on this edition of Closing Trades. It's a goodbye from Aisha, myself, as well as the team who put this show together.